My name is Andrew Housser, co-founder of Bills.com, and today I want to talk to you about mortgage refinances, the good, the bad, and the ugly, and whether they're right for you. Most people look at the idea of refinancing their mortgage to pay off high-interest credit card debt as a no-brainer. The fact is, taking $10,000 of credit card debt at 15, 20, or 25% and turning it into a low-interest mortgage does have its benefits. But it's not a no-brainer. If you're thinking about refinancing your mortgage to pay off your credit card debt, there are a few things you have to keep in mind. First of all, credit card debt is unsecured debt. Unsecured meaning if you can't afford to make your payments, your creditors cannot secure liens on your property. Obviously, a mortgage is secured by your property, secured by your house, perhaps the most valuable thing that you own. So if you're thinking of transferring credit card debt to mortgage debt, make sure that you know you'll be able to afford the payments today and in the future. Because again, if you can't pay your credit card debt, your credit rating will suffer, but you will still own your home. If you can't pay your mortgage, there is a chance you will be foreclosed on. Another thing to consider before refinancing your house to pay off your credit card debt are the fees associated with a mortgage refinance. It's not cheap, typically thousands and thousands of dollars. If you have $10,000 of credit card debt and can pay it off in 2 or 3 years, the interest you would pay on that credit card debt, even at 15 or 20% interest, is probably much less than the fees you would pay to transfer that credit card debt into mortgage debt through a mortgage refinance. A third part of the equation is PMI, private mortgage insurance. If refinancing your mortgage will take the balance of your mortgage over 80% the value of your home, chances are you're going to have to pay private mortgage insurance. It doesn't mean it's a bad decision, it's just something that you need to factor into that equation of whether or not it makes sense to refinance your house to pay off your credit card debt. The final and most important thing for you to remember if you do decide to refinance your mortgage to pay off your credit card debt is don't run those credit cards back up again. It's a mistake that's far too common in America. People refinance their mortgage, pay off their credit card debt, and find themselves with all this free credit available. 3 months later, they find themselves in a worse position than they were before because not only have they raised their mortgage payment through the refinance, they've gone up and run their credit cards back up again. We hope these tips have been valuable to you, and good luck making the right decision as to whether a mortgage refinance is right for you. See you next time. I'm Andrew Housser.